Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Welcome to the podcast. It is Tuesday, July 10th, 2018. Took a week off last week. It was the 4th of July holiday. And rather than scramble and bother potential guests during a holiday week, it's a holiday day, but a lot of people take time off. I thought I would give you all a break from listening to me. I would give myself a break to recharge a little bit, and give my guests a break from having to set out time with the family. So here we are. But I am recording it. It is July 6th, so I'm recording it on Friday, and I'm sitting here. If you hear background noise, there is nothing my fabulous sound engineer Garrett can do to eliminate it, because I am at a friend's house with my family on beautiful Long Beach Island in New Jersey. And while we've had a few great days of weather, it has just been unrelenting rain today, Friday, and it is coming down in buckets with thunder everywhere. So I apologize if you hear the rain in the background, but it's just a hazard for today's podcast. And I know Garrett's a little finicky and he's listening right now and he's probably cringing at the background noise. But so anyway, so we're down here. I came down with my wife and kids. We came down a few days ago and here at the beach. It's beautiful. You know, it's funny, like this might not make sense to most of you listening who aren't from New York and New Jersey, but if you're a New York guy, you're a New York guy. And if you're a Jersey guy, you're a Jersey guy or gal or whatever it may be. And, you know, we have lots of beaches where we are. I live on Long Island and there's 100 miles of coastline. And so I had never really come to Jersey, and it's called the Jersey Shore. And, you know, the only Jersey Shore I knew, I've come to Jersey, but not to the beaches of Jersey in my entire life. And the only Jersey Shore I knew about was the TV show Jersey Shore. And I don't know if any of you ever watched that. I think it was MTV. I forget what it was, but it was about a bunch of young kids who rented a summer house, and, you know, a lot of theatrics went on, and Jersey Shore wasn't my thing, I thought. Phil, a friend of ours, they've been coming down here for 50 years, ever since she was a little girl. And so her family comes down and they have a place here, and they say, you got to come down. So we came down a few years ago, and it's spectacular. It's nothing like I thought from the TV show. It's Long Beach Island is a barrier island that sits right off the coast of Jersey. I don't know how long it is, but it's not terribly long, and it's very, very narrow. But it's pristine beaches. We're in a town called Beach Haven, and it's just beautiful. I mean, the water's crystal clear, much nicer than where I'm at, and the beaches are white sandy beaches, really, really nice. So we're here. Kids are having a great time. I leave here today and I drive to Pennsylvania. My son's in a lacrosse tournament with a bunch of teams from throughout the Northeast and the Mid-Atlantic. So he and I go that way, and my wife and daughter head home. And so that's my weekend coming up, some lacrosse. And as always, you hear me during lacrosse season, always talk about it, but there's no place I'd rather be. And I love watching my son play. And so it's a lot of fun. And we get together now, some of the dads, for the next couple of nights, and drink a few beers while the kids run around the hotel, and it's all good. So, but I got to thinking a lot this week about just markets in general, and I was talking to some friends who are not in the financial markets, and, you know, they ask, I said, you know, how did you do what you do? Like most people don't know what hedge funds are. They don't know what my background is. How do you get into the hedge fund business? And, you know, you might have heard me talk about this before. I think I've said it prior. If you've listened to the podcast, if you haven't, you know, I came into the hedge fund business really by happenstance. I didn't grow up wanting to be a hedge fund analyst. I didn't even really know what a hedge fund was. Grew up very blue collar, certainly no talk around the dinner table about business. And it was just something that wasn't on my radar screen, not until really into my middle-ish 20s and latter 20s, where it even stocks, the markets became something that I even paid attention to. I have an undergrad in accounting, but that wasn't really, becoming a professional investor wasn't on my radar screen. And through a series of coincidences, happenstances, I don't know what you would call it, I was a journalist with an accounting degree at a major financial publication, and used to help the reporters with some of their stories because I understood the balance sheet and cash flow statement. And one thing led to another. It was suggested by an editor that I meet a hedge fund guy because thought I'd be pretty good at it. I met him. One thing led to another. Next thing you know, asked me a few ideas. I looked at a couple of stocks for him. They both worked out based on my research. And I'm a hedge fund guy. And now we're going back over 20 years. And I had no idea really what a hedge fund did at the time. Even I kind of knew they bought and shorted stocks, but really didn't. I certainly didn't have an investment philosophy. I certainly didn't have an investment style. I didn't have strong views about what makes a good business or a bad business. I had grit. I had a work ethic. I would work tirelessly. I was curious. I'm a born skeptic. Unbeknownst to me, those are good traits to have if you're going to be in this business. But so I started out. Many kids come out of school. They know what they want to do. They target the funds they want to work at. I didn't know that. I happened to wind up at a fund that focused on short selling. And I happened to be around a bunch of really savvy old guys who, they weren't old, but they were older than I was, but they were probably in their 40s, late 40s at the time, and been around the business for a while. And they were short sellers. And that was most of the fund. There was a other small portion that did long and short. But, with my ability to understand the numbers, my ability to dig and grind and really just be a grinder, to find information, to research information. And newsletter writers call it boots on the ground. In hedge fund world, you call it primary research. But it's really research that's independent of Wall Street. It's research that requires you to not rely upon company management teams for their guidance. It's research that requires you to not rely upon sell-side research for direction. You might use sell-side research to get you up to speed on a certain industry, because as I and many others are generalists, which I'll talk about later, but I think being a generalist is a great advantage. If you're smart and curious, you could parachute into an industry, spend a few months really getting up to speed on it, understand the nuances, and away you go. But my first exposure in the industry was really just dedicated short selling. And back then, wow, some big thunder going on. But back then, it was about my focus for my first year and a half, 2 years was on the for-profit education sector. And the for-profit education space was a Wall Street darling. It provided non-traditional education to students. And many of these students were first generation in their families to go to college. And on the surface, it was fabulous. You're offering a non-traditional path to students who might not have otherwise gone to college. Many of them were not just out of high school. They were a little bit older. And who wouldn't want that, right? Give people an opportunity to better themselves. And during this time period, the government under Title IV, which is the financial aid portion of it, or the financial portion of funding, both in grants and loans, they kept increasing the amount available to students. Again, a good thing. And sometimes out of good things spring bad things. And in the particular in the for-profit space, what started out very altruistic, you would think, then capital markets get involved. And what you saw was companies being able to raise a lot of money, go out and buy existing vocational schools and invest some capital into them, and then turn into marketing machines. And I again, if you've heard this before, I apologize, but not everyone listens repeatedly. I might have some new listeners. So these schools with this capital turned into really more marketing machines than they did educational machines. And to a trade school, like we all saw them when we were young kids. You were sick on, stayed home from school, you'd put it on and you'd see the technical schools advertising on TV. Well, those were mom and pops and sometimes regional, but then the big guys got involved with capital markets money, public companies, and they started going out and getting students. And at this time the internet was just coming around, but you had a lot of telemarketing, you had a lot, and then the internet marketing came where they had lead generators, and so you started to see that. And you start to see more and more campuses being built. Why? Wall Street loves growth. So if you're tapping the public markets, whether in the form of equity issuance or debt issuance, they want to see growth that will support that when they decide to give you money, either debt or equity. And what these, not all, but what some of these for-profits figured out was, hey, these businesses are pretty scalable. If we have physical campuses, the more behinds we put in seats, the more we're spreading higher revenue over a fixed cost base. That's pretty good. And what'd they do? They grew like weeds. They went out and did everything they could to recruit students. And somewhere along the way, it came up on mine and others' radar. Actually, it didn't come up on mine. The firm I worked at, I was too new in the industry to have noticed it. But some smart guys in hedge fund world said, hey, wait a second. Some of these cash flows don't make sense. Some of the deferred revenue growth doesn't make sense. And there are some inconsistencies in the numbers. And I'll spare you the boring accounting details. So we said, okay, well, you've got Wall Street who really loves the company. Why wouldn't they? Huge revenue growth, huge earnings growth, returns on invested capital through the roof. That's what Wall Street loves. But something wasn't right in the numbers. And Wall Street, when I say Wall Street, I'm talking the investment bankers, the sell side analysts. They're more than likely going to overlook that. I know, the bankers will. They're in business to do deals. And the research analysts, they're under pressure from the firm they work at to not come out and slam a company, because it's hard to get your bankers in the front door. Wow. It's hard to get your bankers in the front door if you are slamming a company in writing. Does it happen? Sure, once in a while. How often? Well, about 5% of the companies on Wall Street have sells on them. A lot have neutrals, which is really, in Wall Street jargon, kind of means stay away, but we're an analyst, we really don't want to say that. But that's just kind of the hidden message. But for the most part, and it's changed now because there have been rules put in place where analysts can't get compensated for the amount of banking business they do. But back then that didn't exist. So you would see a lot of real positive glowing reports. So if you were a long only investor, or if you were a growth investor, right? So, and again, I go back to saying I didn't know what type of style investor I was. These appeal to growth investors, right? And the beautiful thing about Wall Street is you can make money any which way, right? You can be a deep value investor. You can be a momentum investor. You can be a growth investor. You can be a GARP, growth at a reasonable price investor. There's no one way to make money. There's many different ways, and not one way is right and one way is wrong. But these were the darlings of growth investors, high growth investors, and the big mutual funds were owning them, and the stock prices were going higher. Well, my job was to go out and understand what was going on in the field. So I would fly into a city, and I would take construction clothes with me, and I would rent a car, and I would go to a paint store, get some paint. And I apologize if I'm boring you if you've heard this before. Sprinkle a little paint on me, get the local newspaper. They all advertise in the paper then. And I would walk into a night program, the night admissions process, and I would say, hey, I'm moving here in a few weeks. I want to better myself. How do I do that? And can I get a job like this? Big high paying job that you guys say, because they always promise high placement rates. That was a big deal for them. And I would be told that, I should take an exam, and I took the exam, and I just randomly answered anything. I didn't even read the questions. And every time I was always the best student. They told me I had the highest grade that they'd ever seen, and they have a program that could start. And then so that didn't sit right with me. And then I would go outside, and I'd wait for students to come out on their breaks and talk to them, and they'd tell me how bad their experience was, and started to tell me that some of their friends withdrew from classes right away, and they should have gotten a refund, but they didn't. And then in talking to people, they give you their phone numbers, and you track down these former students, and you talk to them, and they kind of explain what's happening. And then you'd find a former professor or an adjunct. You talk to them, why do you leave? And you start to put a mosaic of information together that this wasn't about providing an education. This was about getting as many students in the seats as possible. If they withdrew any amount of time, withhold a registration statement on a certain number of them until the time passed where they didn't get a full refund. And a lot of these kids were put in programs thinking they were getting grants. Instead, they were really loans, and they were straddled with high amounts of debt. Now, after several months of doing this, and I started to put that mosaic of information together, as did some other hedge funds who were looking at this sector, it really started to eat away at me, because I couldn't believe what was happening to these people. Some of these people, their lives were being wrecked because they were left with 20, 30, 40, pick a number, in debt. And they couldn't fight the big corporation. It was their word versus the companies. You went to class, we didn't withdraw you because you didn't withdraw in time. And as you started to see more and more of that, then I really started to struggle. But what I noticed was, at the firm I was at, stock, and I think it was like $8 we shorted. Then it was 10, it was 12, it was 14, it was 16, it was 18. And why? Well, because each quarter they were putting up better and better numbers. And I was baffled by it. Again, I'm brand new at the industry. I don't understand the art of anything, the art of investing. I mean, to my mind, and to the ones around me, it was, we had the goods. We knew that this company and a few others were not doing the right thing, and we would share that information with the appropriate congressional staffers and educational bodies, and nothing was happening. The stock kept going higher and higher, and drew on for a long time, year and a half, something like that. The stock kept going higher, higher, into the 30s. And then one day, clearly the market tells you you're right or wrong, right? And so, and again, I'm ballparking. I don't know. I don't remember for sure. It was a long time ago. $8, you put it on. It wasn't until the mid 30s that one day, one of the educational departments in one of the states put a ban on them for doing something. And then another one followed. And they started to get more pressure. But the bulls didn't believe it. It was a random one-off educational department that had a bone to pick. It didn't really matter, because they would say, if it's okay, shut that school down, they still got all these others, and the cash flow is still amazing, right? So all this stuff hiding in plain sight that was obvious to a bull, it didn't matter, because it didn't affect really the growth rates, because they'd go buy another school to make up for that lost growth. And the stock kept going up and up and up, until one day the FBI raided the main campus. And then the stock started to really rapidly decelerate. But you still had defenders of the stock from the sell side. You still had defenders of the stock from some of the big funds. And I can remember sitting at lunch with a couple of the bulls, sharing my thesis, just over conversation, and them telling me I'm out of my mind. And they were winning. The stock was going higher and higher and higher until it didn't. And then it went to zero. And that was a tremendous lesson for me. And I'm not sure I understood what the lesson was. I don't know that I articulated it like I will now, which was, you could do all this research, and it doesn't matter what you know. It matters if the market gets it, and it matters when the company will start to struggle. So you realize that now I knew what it is, but it's identifying catalysts. It's identifying when the market's going to care, right? In those type of situations, it's very, very difficult because you don't know when something's going to happen. But it can, and it does, but you have to size your positions accordingly. But it taught me what growth investors, and then from there I went to a huge hedge fund. Uh, and I worked for a guy who was a big growth investor, and it was the greatest education of my life. He was a fabulous fund manager, Joe DiMena, and it was an MBA on the job. To me, he's legendary. To many, he's legendary, but he's a growth investor and a great short seller. But what I brought to it was the ability to do deep dive research, to really go out and grind it out, to put the numbers together, to understand the numbers. But even then, after a couple of years in the business and then winding up there, what I would think would be an interesting short, you'd explain why it wasn't. Because who was I to be the arbiter of value? Who was I to be the arbiter of what somebody else should be thinking, even though I knew the work? It's when's it going to, when does it manifest itself? You have to identify catalysts. When could a company stumble? So that was a great education for me. And I've carried it with me through the years. And, as an investor, I through the years, I did a lot of, I'm a value investor, right? I look for things that are beaten up, that I think are mispriced. I'm a terrible growth investor. I don't see, I'm not a big picture guy. I don't have big visions. It's not my strength. But what I learned is to appreciate what big growth investors could look at. It doesn't mean they're wrong and I'm right. It's all about the timing of different things and at different stages. Early on in a company's life cycle, investors may be willing to pay up big time and keep funding a company that's not earning money, that's burning tons of cash. If the vision and the plan for the future is that eventually it will get there. Now, early in my career, a long time in my career, I would look at that and say, that's crazy. How do you know they're going to get there? You don't. But there are people out there who think they will. So you have to respect that. And there are people who will put a lot of money behind that. So I learned early on, you can't short just because you've identified some things in the balance sheet or income statement. You got to understand where it is in the life cycle. But then along the way comes the time where these growth companies with big promises, eventually when they tap the debt and equity markets, eventually they need to start putting up milestones. And sometimes with these companies, the actual realization of those milestones starts to compress the valuation, right? Because now the vision is starting to come to fruition. Now you start to see the challenges they may face, the competition they may face, the reality of what they have. Execution's always an issue. But early on, you have to understand that people don't care about that. Right? Investors, until they don't, can keep funding. So a lot of these companies in these very early growth stages, Amazon is a great example, right? How many times throughout the late 90s, early 2000s, did you hear it was a short, as a short, as a short? Right, it was a short as they decimated an entire sector. They destroyed the industry, and look where they are now. Right, and look how many short sellers have been carried out on it. So you have to learn these different things and know your limitations. And one of the things that I really learned about was rock star CEOs. There are CEOs out there that people truly put their faith in and trust in. Now that's not my thing, but that doesn't mean I'm right. Right. Again, like I said, I'm not a big growth investor. Look, I'm thankful. I've done okay. I put food on my table for my family, a roof over our heads, and I'm thankful. I've been in the business for a long time, because for me it's not work. I haven't worked a day in my life in the last 20-something years. It's just learning and researching and meeting people. It's unbelievable that I've been lucky enough to enjoy what I do. But there are people, right? But like I said, I'm good at a small thing. I'm good at being a value investor sometimes. I make plenty of mistakes. I still do. Uh, I'm I'm okay and good at being a short seller sometimes, and I made plenty of mistakes, and I still do. But it's all the postmortems you learn, identifying the strengths and weaknesses that you have, and try and get better each time. Um, but but one of the things that always has amazed me is the faith that people put in certain management teams and CEOs. And again, that has to go into your calculus when you're thinking about where you are in the life cycle of a company. And then sometimes there's such adoration for for a manager that it becomes almost cult-like, right? And people really put their faith and trust. And again, as somebody, you may not believe in the story, or you may not believe in the ability to get there, but other people may. And by the way, I've seen plenty of those companies where I've doubted the ability to get there, and they do. So again, you do a post-mortem and understand what you missed. It's constantly reevaluating, where have I been wrong? Because in this business, right, in baseball at 300, you're a Hall of Famer. In investing, you'd like to be right 6 or 7 out of 10 times, but you're going to be wrong. So you're constantly reevaluating where you are. So, that, but those are things. Big high growth companies, you always have to be careful until the milestones start to come. Really popular CEOs, they may or may not be geniuses, they may or not be brilliant, but they're held to those milestones eventually by the capital markets, because people will fund hundreds of millions and billions and billions and billions of dollars worth of capital raises. But eventually you need to start putting it up. And as you start to get closer to the reality of being a business, not a business, but being profitable, or as you get closer and closer to having debt that comes due, or if you have a series of missing milestones, even the milestone misses don't matter to bulls, because they'll believe in the bigger picture, and you have to take that into your calculus. So I have a guest on today where we're going to talk about that. And he manages a hedge fund, and he's known for being a very vocal critic of a lightning rod CEO and stock, Elon Musk and Tesla. For full disclosure, in the newsletter that I've shared with my subscribers that I'm bearish on it. But one of the things I see, I'm on Twitter a lot, and this stock to me is just unbelievable with the emotions it generates out of people. One of the things I've learned over the years, I try and keep a pretty level head, and I don't get too torn up. So I find I have my view. I don't have a view that, look, Elon Musk has created something I wouldn't even know how to create, right? He's created a $60 billion business. He was the founder of PayPal. He started with $28,000. God bless him. I wouldn't know how to do that. He's got skills that I would never have. He's called a genius. I don't know if he is, but he's obviously a very bright guy. He's very bright. He's very capable. He's a great marketer. He's able to really engender this great support by a lot of people. So I don't make it personal about an individual versus that. To me, I look at the business. I judge whether or not the milestones have been met. I judge whether or not I think they're going to be met. The competitive nature of the business. What's the pricing going to be? But so I want to fully disclose. I am bearish on it. I do believe that this company has a history of making statements about where they will be, and a timeline keeps getting pushed out. To me, that means a lot. To other bulls, I respect their view. It means nothing, right? They're going to get there. In this particular case, I think that they've gone through a tremendous amount of capital. They're huge amounts of negative free cash flow, and I think that's going to come back to bite them. But I could be wrong, right? That's what makes markets. But we're going to bring somebody on and we're going to talk about it, and we're going to have an open discussion, and we're going to learn more. So without further ado, I'm going to bring on Mark B. Spiegel of Stanphyl Capital. Mark Spiegel, welcome to the podcast.
Thank you. It's great to be here. Thanks for the invite, Mike.
You bet, Mark. So Mark, you run Stanphyl Capital, Tell us your background? People probably know you, which something we'll talk about in a little while. They know you as a guy who's pretty vocal on Tesla, but tell us how you came to the hedge fund world and give us some background so people could get to know you a little bit.
Yeah, so I actually have a very unconventional background for a guy running money on Wall Street and working on Wall Street. In that, I graduated from college in 1983, and I spent the first 17 years of my life in the commercial real estate industry in the boroughs of New York City. And in hindsight, that turned out to actually be a great education for Wall Street, because I dealt with all kinds of real world companies, mostly industrial companies, but commercial companies of all kinds. I learned a lot about their businesses. And I learned in the real world how business works, and how these guys can be real sharks. And where I was working in Brooklyn and Queens, they weren't the kind of polite sharks maybe that they are in Silicon Valley. So it was a great education. And after 17 years, I started getting more and more interested actually in stocks. And so I sold that company to my partner, and I went on to really sort of teach myself finance. I took a couple of years off and really read as much as I could about analyzing financial statements and Wall Street history and even some technical analysis stuff, which sometimes is good for entry and exit points for fundamental positions. And so I did that. And while I was doing that, I absolutely fell in love with a micro cap story stock and put a lot of money into them. And then went to work for them for a year. They're based on the West Coast, but they had nobody in New York to do sort of marketing and sales for them, and I did it. And it was the best education I ever had, because I paid a hell of a lot of tuition. I mean, I lost the bulk of what I put into the company, but I learned that what goes out in the press release, it can have absolutely nothing to do with what's going on inside the company. That was one great lesson, which turned me into a permanent skeptic after that. Yeah. And the other good lesson was actually how slowly things move inside of a business relative to the crazy stuff that its stock price can be doing. Meaning that so much stock action on a daily basis is just kind of random in a way. I mean, it wouldn't be random if you could identify every single participant and figure out why they bought or sold it. But, for all intents and purposes, it can just be random what a stock does in any given day. So anyway, I left them after a year, after, learning a lot and being sort of disillusioned, but in a good way. And at that point, I was 42 years old, and I decided I wanted to work on Wall Street with no resume whatsoever. And this is in 2000, no Wall Street resume. This is in 2003. Yeah. When the markets were still suffering the after effects of the big crash of 2000. And I sent out 1 million resumes. And one young guy at a small investment bank that was located both in New York and Seattle said to himself, hey, this guy spent 17 years in commercial real estate. He helped CEOs find their warehouse, office space, stores, whatever he was doing. And we're investment bankers, and we help CEOs find their money. So if this guy can talk to a CEO, he can talk to a CEO. So he hired me basically on an eat what you kill basis. They got me licensed. I got a 7 in 63. And then they said, okay, go bring in some financing deals and you can share the banking fees with us. Banking fees. So I said, sure. It was exciting, and I had a lot of fun, and I learned a lot, and I did some deals. And then from there, I went on to a larger investment bank, which is not around now, but they had a pretty good presence on the street for a while. And then from there, I got recruited to an even larger investment bank. And what I was doing was I was doing the whole time these deals. They were called private placements in public companies, which basically means they were registered direct and pipe deals for institutional buyers that were not done, as traditional follow-on offerings. So got a lot of deals done, made some money, and at the same time, I was investing my own portfolio, and most of the time was long these sort of deep value micro cap stocks that I'd come across, in my working day. And this was all done with the restrictions. You came from Wall Street yourself, so if you work for an investment bank, you have to get every transaction approved by compliance. You have mandatory hold periods, a lot of complications. But despite that, I did put together a really good record. And so in 2009, I left the investment bank. My heart I wasn't getting along with the guy who hired me there at that point. And, frankly, my heart just wasn't in it. I was tired of raising money for companies that I myself wasn't really interested in investing in. And I just wanted to basically invest and be a buy-side guy. So I did that for a couple more years. And then finally, I opened Stanphyl Capital in 2011. And it started with the usual friends and family money. But I was able to have my personal track record audited for the previous 6 years. And so I was able to market off of that to show people, hey, at least I've got a track record here. So that's the whole story. And mostly what I do, actually, this is a long short fund.
Yeah.
Most of our longs and pretty much the bulk of the money we've made has been, as I mentioned earlier, in deep value micro cap companies with good balance sheets where I can really just buy them cheaply, sort of on an EV to revenue basis. And, every year I would find 3 or 4 of those. And, over 6 months to several years, they would often double for me. I mean, they were terrific. What has cost us performance over the years, especially since 2011, is my short positions. So I was joking with somebody the other day, if I had no short positions at all and just either own cheap stocks or were in cash, and if that were the case, by the way, right now I'd be about 80% in cash because I can find almost nothing cheap enough to add these days. My performance probably would have been, 2 or 3 times what it's been. And as this guy pointed out to me, he's an LP and a hedge fund guy himself. He goes, yeah, but, we always think we're going to be smarter than everybody else. And that's why we always have short positions. So every once in a while they work. I mean, my PA was actually up in 2008 when the markets crashed because I had short positions.
Of course.
So anyway, that's what I do. And that's it in a nutshell.
So you're obviously, when you started Stanphyl, it was natural to be a micro cap deep value investor. But now you're morphing into back in 2011, you've got a short book to put on, and you had shorts, like you said, even before Stanphyl. So how do you think about the shorts? You mentioned what you like on the long side. What's your shorting philosophy?
My shorting philosophy is, and I've violated this occasionally, and when I have, it hasn't done me any good. My shorting philosophy is basically, and this is a cliche, by the way, I'm not the first guy who thought it is, to really avoid valuation shorts and really try to short, things that are frauds or that are zeros or that are just grotesquely overvalued. I mean, I know guys who would be like, I'm going to short, whatever, pick a name because I think it's 30% overvalued. I mean, to me, 30% is like within the range of the margin of error of a stock market valuation, right? So I want to short things that are just like massive bubbles, or, things that are frauds, which I guess by definition, if a fraud is worth anything, it's a massive bubble. So that's what I look for. And, most of the time it's been more macro stuff than individual companies. I mean, I've been short the yen against the dollar since late 2012. I put that on when USD JPY was 79. Wow. And now it's 110. I think it was as high as maybe 125 at one point. So, we've made a little money there. It hasn't been great, but it's cheap to keep on. And, Japan keeps printing and one day that yen's going to implode. I don't know when, but I think there's very low risk for me. And I don't really care if it moves up or down, 10% in the meantime. I'm not a short-term trader, Since July of 2016, I've been short ex-US sovereign debt, dollar hedged. And there's a great ETF that's long that stuff, and you can short the ETF. The ticker's BNDX, Bravo Nancy David X-ray. And it's an incredibly low cost of carry. And, you've got debt there with the average term is over 9 years, and it's yielding, like 80 basis points. And this is absurd. I mean, some of it's Germany, which is, even for Germany, that's absurd, but you've got Italy in there and you've got Japan in there. So it tends to be crazy macro stuff that I tend to short. Except of course for the reason you're talking to me in the first place, which is Tesla.
Well, I was saying in the introduction before you came on, I was telling investor or listeners about my experience with the for-profit education space back in the late 90s. And I was new to the industry, and I was a grinder. Like you, I came in later in my life, and I had an accounting degree, but I didn't understand the art of investing. And I went out and I did primary research. I rolled up my sleeves, and the math didn't make sense in the cash flows and the balance sheet. And we were able to reconcile that with our field work. And the stock went from 8 to 30 something before the FBI raided the company, right? So, and it took a couple of years. And you realize that for me, it was a great lesson. And it doesn't matter what I know. It matters when it's going to come to light. And then I went from there to a really big hedge fund with a great growth investor running it. And there was a great education for me to really understand the psyche of guys who look at big picture growth. And that was really my indoctrination into the capital markets aspect of it, how companies can raise a ton of capital, whether it's through equity or debt markets, on the promise of things to come. And where it becomes a challenge is when they lay out milestones, and when some debt comes due or they continuously miss milestones, they have to pay the piper sometimes. And you see a lot of companies where that happens to. And that's what attracted me to Tesla in the last 6 months. I mean, I've been aware of it, but I hadn't really been that involved in it. But it's been one that has it's really mesmerized me in terms of the Elon Musk, the lightning rod that he is. People either love him or don't love him. But B, their ability to continue to not meet the milestones that they've laid out, keep pushing them to the right. But investors who believe in him and the story just don't care. And so talk about what attracted you to Tesla.
So first of all, I've always been and remain a real car guy.
Mm-hmm.
So that's how I sort of noticed it initially, and I kind of started hearing about it when the stock, had IPO'd, and they didn't pay too much attention. And as the stock started moving up, it started getting more attention. And then I started, I first shorted a tiny bit of this. And when I say tiny, I think I take big concentrated positions in my fund. And this position, I think, maybe it was 1% of the fund, if that, which would be the smallest percent ever. I did that. I think it was like in the high 90s. I think it was around sort of late 2013 when I started just sort of doing back of the envelope calculations of how there was just no way this company could ever grow into its valuation at that time. And I started actually writing about it for Seeking Alpha, and there's a long archive of stories I've written about Tesla and Seeking Alpha. Unfortunately, they started putting everything that's, I think, more than 30 days old behind a paywall, so you can't access much of them anymore.
Yeah.
But it's almost funny if I look back at them. So I'm getting a little ahead of myself. So then as the stock got really crazy, I basically got really huge in Tesla in 2014. I'd have to look at the chart. Maybe it was mid to late. When it got into sort of the mid 200s, and that was what I just considered to be insanity level, and that was like 4 years ago. And so I've had this really big short position in it for 4 years, and it's lost me considerably more money than you would think for, let's say a basis in the mid 200s and a stock that, as I'm talking to you now, is at 308, because as it went up and the news got increasingly bad, I would add to the position.
Mm-hmm.
But then, and then it would keep going up. And then I'm like, well, wait a second, I can only have this such a percentage of AUM. I mean, by this time I was way over the 1%. I was in sort of a more typical position. So you wind up covering, and then it comes down and you think, okay, this is it. The idiots are finally catching on to what this thing is. And then you put it on, and then it goes up and you go up. So just the whipsawing, it cost me as a percentage of, as a loss in this thing a lot more than you would think. I mean, someone pointed out today that literally today is July 6th. The stock is pretty much exactly where it was a year ago. But, I've had some good sized losses on this thing over last year for that reason, because it's just incredible to me, where this stock is. And the funny thing is, I get calls from guys who are short this all the time because, I've been just so forthright about it. And these guys are like experienced guys with a lot more money than I have. And they're like, Mark, 40 years I've been in this business. I've never seen a greater disconnect from reality for this stock. And this is why it's so funny. I mean, just yesterday, Musk was tweeting and whining about the shorts, which of course is the death knell of any company when the CEO does that. I mean, he's stuck now. But at any rate, and I'm just laughing because, yeah, I mean, I do talk to some of these shorts. I never knew any of them before we happened to be involved in this thing, and sometimes they seek me out. And all we've been doing is lamenting to each other. Like, why the hell is this stock going up? So it isn't like there's any cabal of shorts. We're completely controlled, by the market and really by the large mutual funds that have been buying this thing. That's why it's so funny how clueless Musk is about how this stuff works. So anyway, that was a long-winded answer to your question, but there it is.
That was great. I want to come at this talking about Tesla let me come at it from the eyes of a bull, right? So, like I said, I'm bearish on it, but let's, I listen to the bulls, and what amazes me on Twitter anyway, where I see it is the vitriol that comes out of the bull's mouth when anyone has a differing opinion, right? So I go back to Reed Hastings back in 2010 when the CEO of Netflix, when he had Whitney Tilson was very vocal.
He's a very nice guy, by the way. Go ahead. I'm sorry.
Yeah, I don't know Whitney, but I've heard he's a terrific guy. But the way Reed Hastings addressed it was to come out and say, shorting is good for the capital markets. And now let me tell you why I think Whitney's wrong, right? And he addressed it point by point in a very civil manner. But as I hear the bulls, as I understand the bull case is, obviously you have to agree that EVs are superior to internal combustion engines. They will argue they're safer. The performance is better. Your total cost of ownership is better. You have higher residual values, right? And that's the big picture, right? So and of course, you're going to save the planet with from a pollution standpoint. And I do get offended when I see the bulls who say we're doing it to save the planet, like as though I don't have children and I don't care about pollution or anything else. So I could when somebody's on CNBC and proselytizing about that, they could spare me that. And so but then now as we get to more Tesla specific, people reference the great master plan that Elon put out in 2006. He's going to start with this low volume, high price, $110,000 Roadster. And that's going to use the money from that to scale into a lower model, $70,000 vehicle, and then use the profits from the Model S, and then develop the Model 3, right? So you've got this base case $35,000 vehicle. And I'm doing this for the benefit of those who may not be familiar with Tesla. For those who are Tesla fans, but we have a lot of listeners, so some may not be totally familiar. So indulge me here for a moment. So then they'll look back and say, well, he did that. He did the Roadster. He's got the Model S, and now here we are. We're at the promised land. Now we've got almost $10 billion. Or they've got almost $10 billion in debt, and they've burned almost as much in free cash flow. But here we are, and looking at it, they'll say, well, they have a great technological advantage. They've got the autopilot. They have the lowest cost.
False, by the way.
Yeah. So we're going to address these. The lowest cost battery pack, right?
Yeah.
They're close to Silicon Valley, right, where they have all the talent. And that they have this massive infrastructure around the country, and that the competition, which we'll talk about, will have all these stranded assets, whether it's Porsche, BMW, Audi, you name it, because their entire legacy has been built on these assets that will have to be stranded. So let's Let's address this. And one of the things I think I said it just earlier when you and I were talking, but I said earlier in the introduction about milestones, about when you need access to the capital markets and you put milestones out there and debt rating agencies rate you based upon these milestones, or equity shareholders hold you to milestones. With Tesla, the equity holders don't seem to care about the milestones. We're seeing in the debt that the debt holders seem to, because the bonds are trading down, and I think the last I saw was 88 on the bonds. And Moody's did a downgrade back in March. But let's address. So for those out there, are you against electric vehicles? Do you believe in electric vehicles? What's your view?
So here's my view. First of all, I think that particulate air pollution is absolutely disgusting. For instance, what the Europeans did, taking the diesel tests, I mean, those guys should have, and they will, and they did, massive fines, and some of them should go to jail, and they will. I mean, stuff that pollutes the lungs, I mean, I am absolutely for controlling all of that stuff. Yep. When it comes to the automotive contribution to CO2, to global warming, I think it's grotesquely overstated, relative to how much man-made CO2 causes this and how much of it comes from cars. And anybody would be far better off with a 50 mile per gallon light hybrid, at least compared to current battery technology. I mean, you could buy a full-size Honda Accord or Toyota Camry, which gets 50 miles a gallon, than you are lugging around a 1,200-pound battery that gets 250 or 275 miles, takes an hour to fully charge, even on a high-speed charger, has kids in the Congo, hand mining the cobalt for the thing, and then how do you dispose of it? And then there's an excellent chance it's being, charged by coal, or, if not, natural gas, which isn't so bad, but I don't think a 50 mile per gallon car is any worse than that gas. So I'm giving you a long-winded answer, which says I don't think electric cars with their current technology really make sense. But that's only the smallest part of my short case, meaning that the overall addressable market for them is going to be a lot smaller than Tesla bulls think. I mean, the bigger part of my short case is that those legacy makers are coming out with much better electric cars than anything Tesla makes. And they're rolling out, man, like right now on the luxury end. So Tesla's going to wind up like Palm Pilot in whatever size the electric car market is. That's what it is in a nutshell.
So let's talk about the competition. One of the things, so I listen to the bulls, and look, I have a view, and I never assume that I'm right. I always think for where I could be wrong. And I was listening to a prominent bull, and he said recently, look, in the next 3 to 4 years, none of these competitors will be at production scale. They'll be at the volume.
So this is an example. I'm sorry to interrupt you, but that is such a stupid, uninformed, lying, moronic thing to say. The Jaguar I-Pace is available right now in Europe, and it rolls out in U.S. showrooms next month, like the end of August. And what this guy should do, and what I would do if I were on, CNBC opposite him, I would say, let's Google reviews of the Jaguar I-Pace, because that's actually the first luxury EV that's out there. The other ones were sort of the mass market ones that Tesla has actually never built. And every single reviewer, or almost every single reviewer, says this is better than any Tesla ever made. And that's a car that's available now. And this fall, this September, Audi is going to introduce its electric SUV, as will Mercedes. The Mercedes is the ECQ, the Audi is the e-tron Quattro, and they've already shown photos of the interior in both of them. And I guarantee that they are leagues ahead of any Tesla and blow any Tesla away. And the Audi's in showrooms this December in Europe, and they're both available in the U.S. in the spring. And then, of course, Porsche has the Taycan, which they've been giving people rides in. They haven't formally introduced it yet. That'll probably be, my guess is maybe this October. That'll be available next year. all of these cars are far superior to any Tesla, and they're all available between like today, in the case of the Jag, and let's say 12 months from now. So anybody who says that is either disingenuous or just a completely uneducated idiot with his head in the sand.
Yeah, I think one of them was saying that the volumes when these cars come out will be less than where Tesla was in 2013.
That's total bullshit. So Jaguar alone has capacity to make probably somewhere. They haven't formally said it, but it's being built, in Austria by who's that contract manufacturer? Magner Steyr, I think. They should have capacity for around 50 to 60,000 a year, just of the I-Pace. And to put that in perspective, that's 100% of last year's Tesla Model S sales, roughly. I mean, Tesla roughly sold 100,000 cars between S and X. So if you think about the I-Pace, if the I-Pace takes, which it easily could, 20% of Tesla's sales, and then the Audi takes 20%, and then the Mercedes takes 20%, and then the Porsche takes 20%. Okay, the overall market will grow somewhat from these guys, but basically you're going to see Tesla Model S and X sales starting around mid-2019 when everything's available. You're going to see them cut in half or worse from where they are now. So for anybody to pretend otherwise, and by the way, some of these cars are being built on shared lines with other cars, like even I think the Nissan Leaf is built on the same line as other Nissans. And so it's just nonsense when they say, oh, these guys don't want to do this because, the legacy. Listen, auto manufacturers don't own gas stations. They don't own stock and oil companies. They just want market share. They don't give a shit where they, whether it's market share in electric cars and others. Okay. So it's true that the dealers do a little more service on modern cars. I mean, that's the other funny thing. I mean, I hear from these Tesla bulls who talk about modern internal combustion cars as if they were like from the 1940s and still had points and distributor caps. I have a car, it's a 2013. It goes in once a year for an oil change, once every 2 years for a brake fluid change, and that's it. And these cars, the engines don't even need spark plugs anymore on most of them until you hit 100,000 miles. Transmission's good for, 200,000 miles, right? And meanwhile, your battery pack, by the time it's at 100 or 150,000 miles, you're lucky if it hasn't lost 20 or 30% of its range, Tesla covers that up, by the way, by making the packs bigger than they are and then unlocking some of the extra range to give the impression that the degradation isn't so bad. And they also replace the packs, and so that whole argument about, legacy car makers won't do it, it's nonsense. They don't want to lose market share, and they'll do what they have to do to keep the market. Plus, governments are forcing them to do it. They're forcing them to either have a certain amount of no-emission cars, or they have to buy these credits from companies that do, which is, by the way, the only profitable product Tesla has ever had, and that's going to go away as more electric cars come out.
So the other thing you'll hear bulls say is that it has the lowest cost battery at peak levels at a cost per kilowatt hour, and that they've got all this intellectual property in the batteries. So what's your view on that?
Yeah, so a couple of things. Number one, that's complete nonsense, and I'll tell you how I know that's nonsense. Number one, Tesla loses a huge amount of money on its cars, okay, at very high prices, and that's going somewhere besides, SG&A and the other nonsense. And Tesla buys battery cells from Panasonic, okay? Panasonic will sell those batteries to anybody who wants them. There's nothing special about Tesla using them, and in fact, the entire rest of the auto industry, which are all coming out with clean sheet designs, they could have used any kind of battery design they wanted. They've all rejected Tesla's style of battery pack, which is basically wiring together thousands of these little cylindrical cells. The whole rest of the industry is instead wiring together a few hundred of larger cells called pouch cells or prismatic cells. They've made a clear choice for multiple reasons to not do what Tesla's doing, even though they could do what Tesla's doing. And by the way, Musk made a big show a few years ago of open sourcing all his patents. He said anybody wants patents. Nobody wants their patents. Nobody cares about their IP or their patents. So Tesla has no advantage here. As far as cost goes, based on the fact that Tesla Powerwalls, which use similar technologies, it's a slightly different chemistry in the cell, but it's similar in these cylindrical. They sell them for approximately $400 per kilowatt hour, and yet then there's a negative gross margin in that business, which it used to be broken out separately until starting in Q4 when they stopped doing it. You could figure that out. So my guess is Tesla at the pack level. Now the cells, LG, for instance, GM has said that they're paying LG, I believe it's roughly $140 a kilowatt hour for the cells, the cells it's using, but then you have to package those into the packs and put the cooling system in the inverter and all that. My guess is Tesla is probably they could be the high cost battery buyer in the industry. My guess is at the pack level, even now, they're probably somewhere in the range of maybe $220 to $230 a kilowatt hour. And part of the problem is they lock themselves in with legacy contracts with Panasonic. The only reason Panasonic agreed to come into the Gigafactory and install its own equipment, and by the way, they're not a partner, they're a supplier. They came in, they said, okay, we'll put our big battery making machines in, Tesla, if you commit to buying a certain quantity from us at a certain price. And those contracts were made when battery prices may have actually been a little bit higher than they are now. So that's a nonsense argument, and anyone who looks at how much money they lose selling cars at an ASP of $100,000, which is roughly the ASP of S and X before this Model 3 count, you can clearly see that, and the negative gross margins on the Powerwalls, you can clearly see that they're not a low-cost buyer of low-cost manufacturer of battery packs.
So then we turn to the autopilot. Bulls will say it's the market leader, and it's people will randomly pick out a crash here or there, and there's a RIA, I think, out of California or somewhere that's always saying that, well, geez, all cars have accidents or whatever it may be. Where are they in the autopilot?
So there was a study done a few months ago. I forget. Let me see if I can pull it up. Actually, hang on. That showed among every manufacturer developing autopilot that Tesla is actually last. They actually rank at the bottom with their technology. Here it is. Let me see who did this. Let me see who did this study. Just give me a second here. I'm pulling it up. Yeah, it was Navigant, right, which is an independent expert in this stuff. Tesla ranked dead last, and there's a couple of things involved here. Number one, it's unanimously agreed in the industry that you can't have even partial autonomy without LiDAR sensors, laser sensors.
Right.
Tesla doesn't use them. It doesn't use them because they're expensive, and it's trying to save money and just use radar and cameras. Number two, Tesla's software is just a disaster. They've had unbelievable turnover on their team. And in fact, there was a terrific article last summer in the Wall Street Journal when that group had left, and subsequent to that, I think 2 other heads of autopilot had left. And the reason they left was because they warned Musk that he was promoting this system way beyond its capabilities, that it was nowhere near as autonomous as he was making it out to be. And he said he was going to do it anyway, so these guys left. They said, screw it, we're not going to, jeopardize people's safety and be involved with this thing. So, and, if you look at, the cars, they take the wrong off ramp, and that's killed a few people. The automatic emergency braking, which by the way, you can get in a $19,000, I think, Honda Civic now. These things that doesn't work. There have been 2 tests in the last few weeks done by European TV networks where they showed it just crashing into something in their test when like the newest one was done in Luxembourg, I think this week, when the Volvo just comes to a really nice stop. Their system is terrible, and no one with a straight face who's done the research about it can claim anything otherwise. Now, what Musk did was, Musk is a very reckless guy, and he just unleashed this system, out on public roads, which is reckless both for his owners and for anyone else who happens to be unfortunate enough to be on the road at the same time. And it's like responsible automakers just wouldn't do it. They wouldn't promote it the way he did it. They required hands on wheel, the whole time. Cadillac just came out with a system called Super Cruise and actually has eye sensors built in. And if your eyes leave the road, it shuts the system down on you. And Musk just doesn't care about anything. Musk thinks the rules don't apply to him in any possible way. Labor relations, securities laws, you name it. So this is just part of who he is, and it's going to be it's part of what's going to bring him down, besides all the money he loses. Because as far as I know, the guy's never run a business profitably, and he sure as hell doesn't run Tesla profitably.
So one of the things that struck me when I really just started to spend a lot of time looking at it was the amount of management senior executive turnover. And, to me, it was pretty startling. And I think you put out in one of your presentations a list of it. And, so that kind of turnover. And again, like every company has turnover, but I was listening to one of the Tesla bulls. I think it was on Grant Williams' podcast. I was listening. I forget where I heard it, but saying, you know what, that's not concerning at all. This is every company has turnover, and it's nothing out of the ordinary. And to me it is. But what's your view on that?
Well, I mean, don't take my view. Take the view of Jim Chanos, who recently said the only time he's ever seen anywhere near that much turnover was with Enron and Valiant. I mean, these guys are fleeing, leaving millions of dollars on the stock options on the table just to get the hell out of there already. I mean, in March, two of the top three people in the accounting office left at the same time and left behind all kinds of options, right? I mean, there's something wrong there, man. It's almost like these people are like, I'd rather not have my options than be in jail. I mean, it's crazy what's going on there, So it's going to be really interesting to see how this continues to unravel, because, you don't get all these people leaving for no reason.
So you said earlier, you talked about, the shorts who talk to each other. You're not sharing information, but it's lamenting about how is this stock getting here. So you think about the investor base. It's obviously a different investor base, right? That, and they've been okay with funding this negative free cash flow, and the heavy spending. The way they look at it is the heavy spending on R&D and CapEx is all going to gel and come together. And they're okay with that as long as you're seeing that 60-70% growth, and they make the argument that other investors who support traditional car makers wouldn't let them spend $5 billion on a gigafactory. So as long as that growth is going to come, it's fine, and that leads to the Model 3. And so,
but by the way, just to point out, even before the Model 3, it's been completely. Not only has it been profitless growth, but the losses have scaled up with the revenue. I mean, there is no business model here at all. Okay, go ahead. You were going to say about the Model 3.
No. So right. So and that, as a short seller, you have to understand, and you do, who's on the other side of this. So now you're. Recently, I think there was somebody out commenting about the Moody's downgrade, how it was quite curious, and it could have been driven by the short sellers. Because Moody's downgraded at the end of March because a week before production numbers came out. When Tesla issued those bonds back in August of 17, it was based upon, and Moody's wrote this in their report, 5,000 vehicles a month throughout 2018, right? So those were the milestones that Tesla had put out there.
Well, 5,000 Model 3s a week.
Model 3s per week, yes, Model 3s per week. And so clearly that wasn't met in the first quarter. And now in the second quarter, you come out and the Tesla bulls will jump up and down and say, you got your 5,000 Model 3s in the last week. And now they want to hang their hat on that. Now the stock was what, 370 at the time, and it's now 310. But
yeah, because obviously that was total bullshit, because he worked the lines 24/7, which is unsustainable. He worked his employees, from my understanding, 2 12-hour shifts a day for 7 straight days. He cut back on the Model S and X production because there's been very good research done. Tesla Twitter for the bears, which is completely fact driven, unlike anything from the bulls, has been terrific. And one guy who's an environmental engineer pulled all the permits and did all the analysis and figured out that on a steady state basis, the current Tesla paint shop can only do 5,000 cars a week in total, right? So clearly what Tesla did to claim they built, 7,000 in that last week, they started with a bunch of car, 5,000 roughly 5,000 Model 3s and 2,000 S and X. They started with a bunch of cars that were already mostly completed. They ran everything ragged, and the proof of that is another guy on Twitter who's excellent at monitoring factory production. He actually somehow watches the factory gate. Has shown that subsequent to the end of the last day of June, they're back down to producing, cars, a few hundred cars a day, in total, and fewer than that of Model 3s. So the whole thing was a transparent scam that Musk tried to pull off that even the dumbest of the bulls apparently saw through.
So what do you think, what is the end game? As I think about this, for me, the way I view it is, look, and I said this in the intro, I couldn't have built Tesla. I don't have that vision. I don't have the ability to go market, to go get people and rally around me. So I give Musk credit for being able to put together, to put the roadmap together, to build the Roadster, to get the S. Personally, I think they should have stopped there, because I and call me old fashioned, but now you're playing with the major competitors who've been doing this for 100 years, who test vehicles for 5 years. And I know the bulls listening to this are going to say, I'm a dinosaur. I have no idea. It's a tech company. It's a new thing. And I'm ancient. Okay. I'm guilty of that. But this is now where execution has to come into play. And you have $10 billion in debt on your balance sheet. You have over $1 billion coming due in the next 12 months. So now you have to start hitting these milestones. What's going to propel, when you sit around and say, where am I wrong? What enables them to go from burning massive amounts of free cash each quarter to now all of a sudden being able to generate? Because the thing I can't understand is at 350, 60, 70, why are they not raising capital? Because it would seem to me, if and they put out in their press release, we are going to be profitable in the second and third quarters. I almost feel as though at 350, 60, he would have plenty of people from the bull camp who would finance that. What is it? Why aren't they raising capital? And what do you think? How does he get there? What do you see now?
All right. So you're asking two different questions. So let's talk about how he gets there.
Yep.
They can never get there at this point because they have too much accumulated debt, north of 10 billion. I mean, the interest charge on that alone is $600 million a year. Elon Musk is a complete ignoramus about many things, but particularly as far as the car business goes. And nobody could ever work for Musk who actually could instruct him as to how to do things, because for whatever reason he's thin-skinned, his ego can't handle it, and the market isn't big enough to support the SG&A and everything everything it takes to run that company. So I wrote a Seeking Alpha article about this a few years ago, and this is to your point, by the way. They might have had a chance if they focused on sort of being a niche luxury producer of electric cars, and if their ambition had been maybe to grow to the size of Porsche, which I think is around 250,000 cars a year, maybe 275 now. If that had been their ambition, and they were willing to be profitable all the way up and gradually scale in, but that's not what Musk wanted to do. And now the only hope for these guys is to put it into Chapter 11, wash out all the debt, recap the company, and drastically, shrink things down and sort of take it one day at a time. But, at this point, it's too late for that, because, people say, oh, they're a technology company. The technology, I guarantee you, the technology on the Porsche and the Audi and the Jaguar is far more impressive than any technology in a Tesla. For one thing, those cars can run continual laps around the racetrack without overheating, whereas a Tesla Model S and X goes into limp mode after about, a minute and a half of full throttle driving. The Model 3 may be better because it switched to a different kind of motor. So there's no, the new Audi electric SUV is going to have actually 3 motors on it. Tesla has a dual motor. I mean, their technology, I'm telling you, they're Palm Pilot. So, the bulls may not want to hear it, but, I'll tell you, let me take a step back and then I'll answer your financing question. My longtime girlfriend, she's very smart. She knows nothing about cars, nothing about finance. She's a medical doctor, but she's smart. And, about 2 years ago when I was lamenting about how the market should be seeing everything that's happening now and should be a discounting mechanism, blah, 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 she said to me, listen, this stock may not collapse until the Audis and the Mercedes and the Porsches are in the showrooms and people actually believe and can see how inferior Tesla is to those guys, which, by the way, as an aside, are all going to be priced lower than the similar Tesla model. Like the Jaguar starts $10,000 less than the least expensive Model X. And as Tesla's tax credits start running out later this year, it's going to be, eventually it'll be as much as $17,000 cheaper for a while. The Audi electric SUV, which looks spectacular, looks to be approximately $12,000 less than the cheapest Model X. The Porsche Taycan looks as if it will price about the same starting price as the starting Model S, around $75,000. And of course, the Porsche will get the tax credit. I mean, good luck to Tesla having anybody buy a Tesla when you can buy the Audi, Jaguar or Porsche for actually less money and get the and get the superior technology. So to your financing question, at 350, I doubt that any deep-pocketed bulls would have stepped up. However, I'm an ex-capital markets guy from my investment banking days, and when you have a stock, trading an average of 8 million shares a day at $350 a share, so you're doing what? Close to $3 billion a day of trading. You can always, do an equity deal if you make it a sweet enough discount. They don't have to be bulls or long-term investors. You could quickly raise $2 billion selling the stock discounted, 7 or 8%, and guys will blow it out the next day. And so what? Tesla will have its money and it can go on from there. And yet they didn't do it, right? They didn't do it. And there's a lot of theorizing going on, but with no proof yet, but yet no denial from Tesla that there's a major SEC investigation going on at Tesla, that they may have either been served with a Wells notice or may have been notified that they're close to being served with a Wells notice, and that Tesla has been unwilling to disclose this and therefore hasn't been able to, file a registration statement to get a deal done. It's all speculation, but it's all informed speculation. And again, some guys have put terrific charts up on Twitter with all the circumstantial, and by the way, admittedly fully circumstantial evidence for this. So that could explain, why they haven't raised money, that they're having SEC problems.
It's interesting. You've seen a lot in your career. I've shorting stocks for 20 years plus. I've seen a lot. That would be beyond the pale to be in possession and not notify, or to be aware of and not.
Believe it or not, it's actually legal. There was some case law on it, which I looked up, and you are not required to disclose that you've received a Wells notice as a corporation. Now, that doesn't mean you can sell fresh stock that way. I'm not sure what the legality is of that. I'm 100% sure that no major investment bank, would take the liability of underwriting your deal if you were under a Wells notice and didn't disclose it. So they could be under one, despite the fact they haven't disclosed it, and that could be legal. But it could explain why they're not raising money, because they don't want to disclose it, or maybe they couldn't find an underwriter if it were disclosed.
Yep. So now the bulls will say that this is the ramp we're going to see, the 5,000 Model 3s, and you explain why, right? And they're building it in a tent, and
Well, only some of them in the tent.
Only some of them. What?
Which, by the way, Musk says is better than the other assembly line that's in an actual building that they spent billions of dollars on.
Right.
I don't know what that means.
1,000 built in the tent. Yeah, exactly. So give me the where you're wrong scenario. How do they get, because at this point the company needs the Model 3 to be a success and very fast, right? How do they get there?
The problem is they can't make money on the Model 3. So, Musk has effectively got everybody to focus on production. I mean, this is one of his skills, is trying to steer people into where he wants them to pay it. Look at this shiny object here. Don't look over there. When in fact, he finally admitted, I think a month or two ago, he basically tweeted that we can't build a $35,000 car, which was the one that was promoted to the world, and a lot of lazy media outlets still use that as the base price. He tweeted, we can't because we'll lose so much money on it that Tesla will die. I mean, that was his words. Tesla will die if we build a $35,000 Model 3. So they keep putting it off and promising it, for sometime next year. And the problem is there is nowhere near 5,000 a week steady state demand, even worldwide, for a Model 3 that starts as it does now at $50,000. There just isn't enough demand. So, and Tesla doesn't want to admit that. I mean, people who monitor, and again, great work on Twitter from other people, they monitor the forums and the spreadsheets and the people who come in and say, have you configured your car yet? And they calculate what percentage of the overall buyers these active people are. And they just come up with serious demand problems for this car. So, I mean, it's not, by the way, it's not that it won't sell at all. I mean, at 50,000 and up, maybe they could sell worldwide, I don't know, 120,000 a year of them, 150,000 a year of them. In the best case, 3,000 a week. There isn't demand for 5,000 a week. This car will not get them profitable. Where the demand was for the $35,000 car, and they can't build it. They would lose too much money on it.
So I assume Elon Musk wouldn't want to take advice from you, but if you were giving it to him, what would you do if you were Tesla right now? And would you, and obviously with the debt, you're scaled to the company size that you are with the expectations of Model 3, but how do they turn this around? And it's very funny. We're actually talking about turning around a company that stock price has gone parabolic over the last several years, right? And I do chuckle when, and I know the bulls get very angry and they talk about how brutal it is. The stock, look at the stock price. They're winning, right? They've won so far. So they get all worked up, and I don't know why. I mean, they've won. What do you do if you're Tesla?
Well, by the way, I mean, they sort of run. I mean, won. I mean, look, relative to the NASDAQ, it's a huge trailer over the last 4 years, actually.
Yeah,
but
that's true. Yes.
But they've certainly won from $35 a share in early 2013, whenever, right? I mean, over a long time. It's stalled out sort of somewhat lately, but they've won. There's no question. So my answer to Musk would be, you got to throw this thing into 11. You got to get rid of the debt. You got to restructure it, and you just got to scale everything way down. But listen, Musk is one of the biggest hypocrites in history. I mean, the guy says he's saving the world. Meanwhile, he flies all over the world, including weekend jaunts with an actress girlfriend in a Gulfstream G650ER, which is the largest non-airliner private jet you can buy, right? I mean, and he just uses that like you and I would, hop down to the supermarket, for an hour. And he owns multiple connected mansions in Bel Air. His bigger hobby and fun is, launching rockets. I mean, how much CO2 does one rocket put out, right? How many cars worth is that? So, I mean, the guy's a total hypocrite. And, he was if you read his bio, he was a geek that nobody liked when he was growing up. And so now he likes to throw the money around and date the actresses or the wacky singer he's dating now, Grimes. And, that takes real cash. So, he would not be happy if Tesla were restructured and, had a $3 or $4 billion market cap, and made a few $100 million a year, that's not going to support the lifestyle this guy's looking at, much less the margin calls he'd get. I mean, he's already borrowed against 40% of his stock. And, at a certain point, and we're not sure where the number is, he's going to get slammed with some big margin calls, which I guess wouldn't matter anyway if he threw the company into 11 and just started it over. But that's really what he should do. But his ego won't allow it. But it's not going to matter. He's not going to have the say in it. His creditors will do it to him, or his suppliers will do it to him.
So I guess a few weeks ago, he's very active on Twitter, as everyone knows. He was out talking about 3 weeks, the shorts. It's going to be the short burn of the century, and right before they announced their numbers, he tweeted something about who likes short shorts with a video. So I guess he was talking about the numbers he was going to put up, because he might have miscalculated there because the stock's down since then. So I've heard other bulls speculate that no, that wasn't it, but there's probably a big investment coming. How do you think about that from outside investment into Tesla?
So a company that has a large strategic investor about to come in doesn't lay off across the board, as he did a few weeks ago, 9% of its workforce, including lots of engineers that you would need, to grow this thing. If you really wanted to be able to make a Model Y and a new Roadster and a truck, you can't be. And by the way, the Model S and X are now, 6 years old. You can't be and need a major refresh. You can't be just laying off all these engineers and all these salespeople. The top execs would not be fleeing in droves like rats leaving a sinking ship if there was fresh money coming in. Musk would pull them aside and say, guys, I know things have been tough lately, but just hold tight. Another 2 weeks or so, we should get this big injection from, dumb Chinese company A, right? So I don't think any of that is happening. Now, they could announce a Chinese factory. I mean, supposedly they've been approved for it, although this new trade war between China and the U.S. may throw a wrench into that. I mean, we didn't even talk about it, but, starting literally today, every Tesla being sold in China is getting slapped with a 40% tariff. China was over 20% of Tesla's automotive sales last year with a 15% tariff. Now there's a 40% tariff. So you can kiss China goodbye for this company as long as that's around. But, so maybe they throw up a factory there. But the thing is, that would not be an investor directly in Tesla. And B, the big Chinese conglomerates have realized that in any kind of a build versus buy scenario, it's cheaper to build. So they're doing startup electric car companies, or, they're putting money into ones that are a few years old, because basically, you could design an electric car and build a factory and do everything you want to do, for, I don't know, $4 or $5 billion, have the whole car engineered, maybe 2 models, the factory, everything, sales set up, maybe $5 billion. Why the hell would somebody pay, a Tesla enterprise value of close to $70 billion, which it is with the debt? So they're a victim of their own size. So I think whatever he announces would not be meaningful if there is anything to announce. And frankly, he's not acting like a guy who's got anything to announce. A guy like that doesn't whine and whine about the shorts and fire all these people and do the crazy stuff he's doing. He confidently sits back and springs it on him, right? And that's not happening here, I don't think.
Well, anything I didn't touch upon, Mark, that you have on your chest that you want to talk about?
Well, I mean, one thing we didn't talk about is, we talked about the financial reasons why this company isn't going to make it, and we talked about the competitive reasons why they're really screwed, like starting now and over the next, let's say 12 to 14 months. But we didn't talk about, Elon Musk himself, who is just in my opinion, continually commits securities fraud through misleading. And by the way, there are lawsuits out there citing lots of examples of this, through all kinds of misleading guidance, misleading predictions. I mean, it's funny. Bulls will say, yeah, that's just Elon. He's just optimistic. That's how he works. He sets stretch goals. We know he doesn't really mean it. Well, it's one thing to do that. It's another thing to be on a conference call, which is, by the way, when this whole thing started, I had no opinion of Musk. It's not like I shorted this originally because of Musk. I shorted it because of the financials and the business. But, starting a few years ago when I heard him on a conference call and he said, Tesla doesn't discount our cars for anybody. Everybody pays full price for a Tesla. And at the same time, you could have gone up on the web, on not their website, on this other website to track it, and pulled hundreds of brand new inventory cars at 4 and 5 figure discounts with no mileage on them, right? And they had this discount referral program going. And here's the guy in a conference call saying, we don't discount our cars right. First time I heard that, I'm like, okay, that's just fraud to say that. And this other thing is going on. This goes beyond, a bad business model. This guy is a liar and is another very good reason to be short this thing. So I could cite a lot more examples of it, but that's sort of the third tier of this thing. The financials, the competition, and Musk's fraudulent claims. That's the third tier of why I think this company is not going to make it.
I really enjoyed speaking with you. So for anyone listening, you and I have never spoken before today. I shot you a Twitter DM and asked you to come on, and you were gracious with your time. And I appreciate it. I think we spoke for a couple of minutes before we started the recording, and we were saying how, we're both on Twitter and there's never a dull moment with this company, unlike anything I've ever seen.
Yeah, well, exactly. It's, it's certainly the most entertaining giant scam I've ever seen. And just because of how big it is and how much press it gets. And on some level, I'm going to miss it. But you know what? On another level, I've been short this thing in size for 4 years. I'm ready for it to just be over already. So thank you very much for having me on the show. It was great. It was a lot of fun. If you're ever in New York, let me know, and we'll grab a few beers.
Absolutely. You bet. Thanks, Mark.
Take care. Bye-bye.
That was Mark Spiegel. I hope you enjoyed my interview with him. Mark and I just met for the first time today over the phone. We touched base a couple of times on Twitter, but he surely is a vocal critic of the company and of Elon Musk. He's been in short the company for a number of years, as you heard him say. My views on Twitter on Tesla are, look, for me, I look at it from a business standpoint. I'm doubtful that they'll be able to meet their targets, but hey, like I said, that I don't like on Twitter. It's become a lightning rod, and it's become a war of words between the bulls and the bears, and that bothers me because people have opinions. Bulls and bears make money. Sometimes you're right, sometimes you're wrong. This has taken on Twitter, it's just gone. It's at a level that I've not seen before. But on one hand, it's entertaining. On the other hand, you say, wow, why people just have differing opinions. But that's just my view. So for whatever that's worth. So anyway, I hope you enjoyed it. And I just did want to share a very hotly contested company. So have a great week, and we'll speak next week. Thanks.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.